Hi, my name is Dan LaMontagne. It's January 3rd, 2009. Well, today we had the Federal Reserve Chairman Ben Bernanke speaking in front of the American Economic Association, and he's trying to explain today that the interest rate reductions from 2002 to 2006 were not responsible for making the housing bubble grow or get worse. Because that's been one of his principal criticisms from other economists around the world, is that the fact that the Fed slashed interest rates down to 1% had a major role in causing the housing bubble and the crash. Now, Ben Bernanke refutes this argument. He says that the real cause of the economic downturn was the fact that we had lax lending standards and that we had artificially low interest payments. People were getting these subprime mortgages that were not backed by the government. That was the real cause, according to Ben Bernanke, and not the fact that he had lowered, that Alan Greenspan had lowered interest rates down to 1%. Alan Greenspan was the former Fed chairman. Now, what Ben Bernanke doesn't point out is the fact that the common sense that with interest rates, there's going to be, even Alan Greenspan, the former Fed chairman, admitted before the housing bubble crashed that there was quote-unquote froth in the market. And what he meant by that was that it could have a significant pullback in terms of housing prices. And the reason that we would expect housing prices to increase when you lower interest rates is pretty simple. If you think about it, let's imagine that you have a house that you want to buy, and it's $100,000. And the bank is going to offer you an interest rate of 1%. Well, it's a pretty good interest rate, for you, because you only have to pay, $1,000 every year in interest. And the rest of it, you can put towards your equity, right? So you'd think that, I'm going to pay this house off pretty quick. So, yeah, sure, I'm going to go out and buy that house. In fact, why not buy a $100,000 house? Let's buy a $200,000 house because it's only $2,000. That's nothing. Or let's try a $500,000 house. That's only $5,000. So people were, the interest rates weren't 1% to the consumer, but they were 1% at the level that the Fed was loaning to the banks. So the banks were able to make extremely low interest offerings to their banking clients, the people who were looking to buy houses. So people were buying houses that were much more expensive than they would have normally paid for. And what this ended up causing was all houses were getting their prices driven up because since no one really cared, since people were looking to buy more expensive houses, people who owned houses figured they could get more money for their houses, so they started bidding them up. So that was one reason for the fact that the housing prices were increasing with low interest rates. Think about the opposite example. If you had a house that was $100,000 and the interest on the loan was 20%, well, then you're going to have to pay $20,000 every year in interest for every year you hold the whole balance of that $100,000 loan. So clearly you're going to want to go with a less expensive house. And so since houses are not going to be sold on the market at a 20% rate, it's going to be harder for sellers to get rid of their homes, therefore housing prices will fall. So what the main argument that Ben Bernanke is making is that these interest rates had a very minimal impact on housing prices, and that just isn't so. That's just not how economics work. When you have low interest rates, you're going to have higher housing prices. Now, another thing that he points out is that he had to lower the interest rates, that the Fed had to lower the interest rates because there would have been economic consequences in the medium term. Well, I would argue that there would have been economic consequences in the short term and maybe the medium term, but we're going to have much worse economic consequences in the long term by holding these interest rates lower. In fact, now the Fed chairman doesn't have the interest rates at 1% like Alan Greenspan did during the housing bubble. We have them at 0%. And this is supposed to be stimulating the economy. Alan Greenspan, the former Fed chairman before Bernanke, lowered interest rates to 1% to prevent us from going into recession from the stock market crash of the early 2000s. And now Ben Bernanke is trying to prevent us from going into a recession from the housing market by keeping interest rates now at 0%. But think about what ended up happening in the aftermath of Alan Greenspan slashing the interest rates down to 1%. We had the housing bubble burst. All of the money that was in the stock market was transferred into the housing market because Alan Greenspan lowered the interest rates down to 1%. So the same people who were speculating on internet stocks shifted all their money into real estate. And doesn't Ben Bernanke see a pattern? I mean, if you're going to slash interest rates and you're going to create a bubble, why do it again? So anyway, he's continues to put blame on the free market, saying that the real cause was these greedy companies which had lax lending standards and were looking to, destroy these homeowners and put them out on the streets because they had these artificially low interest payments that would be reset upward to these ridiculously high interest rates. I mean, think about how ridiculous that is. If you're an investor, you want to have a steady source of income. I mean, people who loan money out want to know that it's going to be paid back, right? So why on earth would these monster banks start making loans that were outrageous? I mean, wouldn't they want to get paid back? I mean, sure, you can make the interest on the loan and it might be really high, but if your tenant goes out of business, I mean, not only is it bad for the homeowner who's going to lose his home, but it's bad for the lender. I mean, the lender doesn't want to overcharge a tenant or doesn't want to overcharge a homeowner because he's not going to get his money back. So think about why. Why were the homeowners given these lax lending, these lax loans? Why were these homeowners able to borrow so much more at such a cheap original interest rate and then have the terms of the interest rate be so outrageous? I mean, what benefit would that have to the loan company? Why did that happen? It did happen. Well, the reason that we had these lax lending standards was not because all of a sudden all these Wall Street bankers got greedy. It's because our government guaranteed the loans. That's like telling you, go ahead, go to Vegas and make as many bets as you want. Make the riskiest bet you possibly want. You know what? We're going to pay for everything you lose. And that's exactly what happened. The government had this guarantee on all these housing loans telling anybody who had money in Fannie Mae and Freddie Mac, all these big, you remember those two big mortgage giants that almost went out of business before the government bought them out? Well, the reason that they almost went out of business was that they were bankrupt from all these loans going bad. And the only reason they didn't go under is that the government held up their end of the deal to reimburse every investor who made these loans. And the fact is the government should not have backed up those loans. I mean, if the government didn't back up loans, then you wouldn't have any Joe Schmo being able to buy a house, which would be, unfortunate for some people who have, bad credit or, don't have a lot of, income, but it would prevent that person from getting into a loan that would be hazardous to them. And it would prevent them from being put out on the streets and losing everything. Rather than the government encouraging people to buy these overpriced homes, they should really be encouraging people to rent. Because rent right now is much lower in terms of cost than purchasing a home. Well, anyway, I just wanted to bring these current events to the attention of all the viewers out there, and I hope you have a good day.